All right. Well, good morning, everyone, and welcome to the OneAscent Market Update for Q1 2025. It seems like everybody's getting signed in and logged in. My name is Cole Pearson. I'm the president of Investment Solutions. I'll be your host this morning. As we do, let me open our time with a brief word of prayer as we get started this morning. Let me pray. Heavenly Father God, thank you for today. Thank you for a new day. Thank you for the chance to gather with people from all over the country together via technology. Lord, I thank you for each family represented on this call. Thank you for the opportunity to steward resources, financial resources, and otherwise, and to talk about markets and to talk about things that are going on in our world. Lord, I pray that you be with our speakers today, be with our audience, give us ears to hear and the words to speak. And we pray that you get the honor and the glory. We ask this in your perfect Son's name. Amen. Amen. Well, again, welcome to the OneAscent Market Update for Q1 2025. We're excited to be with you this morning and have a lot of great information to share. I'm going to get us kicked off here with just a brief overview, and I'll be excited to invite on my colleagues Nathan Willis and Peter Klingelhofer to share with us about the markets and what's going on in the markets. As we do always, if you have questions throughout this call, we're going to end with a time for Q&A. You can email those to info@oneascent.com. You can also use the Q&A function built in here into Zoom. Send us your questions and we'll get them answered at the end of our time. These calls we hold every quarter, the third Tuesday of the quarter at 10 a.m. So you can go ahead and mark your calendars for April 15th, which will be our next call. As we get started today, we are going to be talking about markets and a new year and looking back on what happened in the past year. But I want to, as we do, I want to remind us of why we do what we do. We invest. Yes, we invest in public and private markets. But one of the things that makes OneAscent unique is that we practice what we call values-based investing. That simply means helping you align your values with your investments. And here's just a simple definition of what does it mean to do values-based investing. It's deploying financial resources, because it is investing, in a manner that aligns with a set of values or convictions to accomplish a financial return. We are still trying to meet our risk and return objectives. We're just doing that in a way that aligns with our values. And so a layer deeper of what that might look like and how we approach that at OneAscent, we have what we call our 3 E's. So what type of values are we aligning with? First, our process is to eliminate. We eliminate certain companies from our universe whose products or practices we believe cause harm. Things that are addictive, things that prey on the poor. And so we remove those from our universe. Second, though, we evaluate. We're looking for companies that meet our investment objectives. We are still, in fact, investing. But finally, for us, values-based investing is not simply avoiding. If you'll go back one more quick slide, Nathan, not just simply avoiding, but elevating companies that make the world a better place. We are going to be placing capital and stewarding capital into businesses and companies. And so we want to see that the businesses we own are bringing blessing. The way that we do this, and we do it with excellence in a repeatable way, is through our process and our tools. And so our Elevate tool that you can see here, it's our proprietary screening platform that we use to execute on this approach on your behalf. We have almost 4 million data points that are updated on a nightly and weekly basis. We can look at 70,000 different issuers across our different categories. Again, all with the goal of making sure that we're using best-in-class data to make sure that we're actually doing what we say we do, helping you align your values with your investments. And so if you want to know more, we'd love to share more about that with you. What we really hope to be is your partner in values alignment. As you think about the financial resources that you steward, that looks like 3 things. One is solutions. So today we're going to talk about mostly the public markets, but we offer a range of solutions, investment strategies and products in the public and private markets to help you implement your values. We also do that through tools. This is our Align platform. If you're an advisor on the call today and you don't have access to Align, we'd love to get you set up. If you're a client or an investor on the call this morning, we'd ask your advisor, hey, can you take me through the Align platform? We've built lots of tools and assessments to help you gauge and evaluate where you are, what you value, and how you can align that into your financial journey. And then lastly, we partner with you through insights, all kinds of resources. Today, down in the bottom right corner is our webinars. This is our market update webinar we do every quarter, but we equip you as advisors and investors to help you be clear on what types of companies you own, what's happening in the markets, all types of things so that you can, again, align your values with your investments from A to Z. And so we're grateful to do that. But today we're going to talk about what's going on in the markets. And so I'm excited to bring up our Director of Research and one of our senior portfolio managers, Pete Klingelhofer, who will get us kicked off today with an update on our outlook from our Asset Allocation Committee. So Pete, thanks for joining the call.
Excellent. Cole, thank you for that intro, and I'm happy to move forward and discuss the outlook and a little bit of a review of the fourth quarter. So we're going to start off with a review of what happened in Q4 and in 2024. And then we're going to take a deep dive into our navigator process and the investment outlook that we generate as a result of that. And then we'll consider some portfolio construction ideas and give you some ideas and actions that you should take in your portfolios. So we'll move on to the next slide here. And as you look at what happened in the fourth quarter, obviously the election had a big impact, right? The election changed the tenor of the quarter. Going into the election, the month of October, international was doing okay. But as you can see here, that didn't work out quite the same way. And large cap stocks, you see over on the left, they outperformed. That's the obvious thing on the left, but international suffered pretty tremendously in the quarter. That was kind of a knee-jerk reaction to the election and the tariff talk that came out of that. And we'll dig into that a little more as the call goes on. But also, as a result of what was happening throughout the year and specifically in the fourth quarter, the expectation that the economy was going to be stronger for longer, that led to some fears of inflation, and that led to higher interest rates. So bonds posted weak results in Q4 as well. Meanwhile, we're talking about all these issues, but the 900-pound gorilla for the quarter was the Magnificent Seven dominance in returns. As you can see, that was a huge spike in Q4 relative to everything else on the page, and it impacted everything. In fact, the S&P 500 would have barely been up were it not for the Magnificent Seven. And in fact, without dividends, the other 493 were basically flat to down. So the interesting thing as we go to the next slide is that Q4 was sort of a microcosm for the entire year. And you can see that Magnificent Seven concentration drove the S&P 500. And also, as a result, you can see that the other asset classes lagged pretty significantly when you compare them on a relative basis. But the Russell 2500 up 12% was actually in line with this last 15 years, as you'll see in another slide later. Interest rates firmer, the economy was effectively stronger than people thought it was going to be at the beginning of the year. So this is the return profile that 2024 delivered. As we dig a little further, we got sector returns on the next page. The interesting thing here is we're sort of reflecting that narrow performance on this page. You can see it on the left side. Technology sectors were the big driver in Q4, and they were for the year. But if you were on our call in October, you might remember that at that point in time, utilities were actually the leading sector at the end of September. And they obviously had a down quarter in Q4, and they ended up in 5th place for the year. And the point on this slide is that most value sectors on the right lagged. The only sector that managed to do well was financials in that regard. But the other thing to think about, and this is a theme of this call, if you will, is sometimes it's important to turn things upside down. And the theme should be inversion. Sometimes you have to invert what you're looking at to explain it and to understand it. And if you think about the left side of this slide, I would say that most of those areas, not all, but most, are highly priced or expensive, and they have very high expectations for the future. And that the sectors on the right are generally on the cheaper end, and they have low expectations for the future. So if you think about that, what is the fishing pond that you should be thinking about looking forward? You don't have a high probability of success when you're overpaying and you have high expectations. And we know that from lots of areas in our lives, right? Not just investing. So I think that's important when you talk to clients. So as we move on to this next slide, we can explain how we got to now. This is just to give you some background on why it ended up the way it's ended up, right? AI-driven tech stocks, as you can see by the light blue or maybe the bright blue line here. In 23 and 24, they had tremendous earnings growth. But remember, a big part of the reason was where they were coming from. In 2022, their earnings were negative to the tune of 20%, right? And that set a low bar at the end of 2022. Recall that stocks like Meta and Nvidia were down 70% in 2022. Well, when you're down that much and you get an earnings recovery, well, you can have tremendous performance. But looking forward, this is the important thing. That extreme performance in relative earnings, that's going away, right? So what does that mean? That means earnings breadth is expected to increase throughout this coming year. And this should be really good for small and mid caps because that theme of broadening is extended down to that area as well. And a point at the bottom of this chart that came out of a JP Morgan slide at the end of the year, the other 493 companies only contributed about a third or less of earnings growth in 2024. So really 7 companies contributed, 70 to 80% of earnings. But next year that flips, right? That's the inversion that I'm talking about. That's where you turn the world upside down. So 73% of earnings next year is going to come from the other 493. That's a much broader market, and that is going to offer much better return potential for diversified portfolios. And I think now it's time for me to turn it over to Nathan, who's going to give you some background on our navigator and some of the economic data that we are looking at.
Thanks, Pete. It strikes me that Pete has gotten to talk about some really good optimistic things, and I get to talk about the bad news, which is inflation. So as you can see here, we've got a really long, 25-year chart of inflation, and it was very, very low during this whole time up until the post-COVID period, and really shot up, and it's come back down. We've had a really good disinflationary trend during 2023 and 2024, but that really kind of took a pause in the fourth quarter. We like to say that the inflation data hit a bump in the road. So both core CPI, which is consumers, and core PCE, which is the data that the Fed prefers to use. Both of those kind of took a little bit of a bump up during the fourth quarter, and that's partly what drove bond returns. And so it's important to understand this data, but it's also important to understand what the Fed thinks about this data. So we're going to show something that we've been using for a while, and it is artificial intelligence. And so this top chart here is by Bloomberg. And it is Bloomberg's natural language processing model where they go look at Fed speeches. So Fed board members, when they go out and talk, the Bloomberg model goes through and figures out if they are hawkish at the top there, which means that they are more prone to rise rates, or if they're dovish, which means they're more prone to lower rates. And so this chart goes back 5 years, and you can see here they were pretty dovish during COVID and after COVID, right? And that was very logical. But then beginning in 2021, as you started to see inflationary pressures and supply chain issues and all that, they got a little bit more hawkish. And you can see there's a really good correlation between them getting more hawkish or more prone to raise rates and them actually starting to raise rates. And so what I want to look at, though, is what happened in the fourth quarter. And this is actually, we're going to do this on the next chart by looking at all of 2024. And what we're going to do is we're going to look at inflation through the lens of what the Fed thinks. And then we're going to look at interest rates through the lens of what the Fed did and what the market did, or how the market reacted. And that's what we're looking at on the bottom that I haven't mentioned yet. But you can see the gold is the 10-year Treasury yield, which rose obviously as the Fed was raising rates. And then Fed funds is in blue. And so when we look at 2024, it's really interesting to see the market beginning in the third quarter was pretty convinced that the Fed was going to lower rates a bunch. Okay. But the Fed wasn't so convinced. In fact, they only got a little tiny bit dovish right after they lowered rates in September. And you can see here what happened. The market kind of caught on. So as the Fed lowered Fed funds over 1% over the fourth quarter. So forgive me, bonds are a little boring, so we got to make them exciting. Treasury yields jumped up 1%. So the Fed drops rates 1%. The market says, nope, interest rates are going up 1%. And why is that? It's because the market was worried about inflation. The market is worried now that the Fed is lowering rates too soon and too much because growth is still strong. And so we're going to get inflation again, and we'll see a 2022 repeat. Okay. So another way to look at this is the market expectations for 2025 rate cuts. So we just looked at what actually happened to bond yields in 2024 fourth quarter. These are the expectations for next year. And what I'm going to do is I'm going to just point you to the right side here. So this is the expected number of rate cuts in 2025. And you can see here, when the Fed cut rates in September, it had already begun to unwind a little bit. But at that point, 5, and maybe by the time they cut rates, 4 rate cuts were going to happen in 2025. Well, all that has come out of the market because inflation is strong, high, and growth is strong. And right now, the market only thinks that maybe we're going to have, 1 rate cut next year. And so that is really, really impactful. And so thinking about the theme of inversion, we got to think a little bit about kind of what is driving what. And so historically, what you think of is the bond market is way larger than the stock market, and the bond market or interest rates really drive stocks. Well, for 20 years, that hasn't been relevant because bond rates, bond yields were so low that stocks could kind of react to their earnings. But now we've seen over the last couple of years, the movement in bond yields is really important as a driver for the movement in stock prices. And so how do we think about that? Fortunately, we have a great framework. It is our navigator framework. And so we look at 4 pieces of the puzzle, and we're going to go through those now. We look at the economy, we look at market technicals, market, consumer, and company sentiment, and then we look at stock and bond valuations. So let's dive in and see what the data tells us. So first of all, this is the Atlanta Fed real GDP. It's called a nowcast, so it takes all the data and weights it, and it shows you kind of a current real-time expectation. And what it says is fourth quarter growth is still going to be about 3%. So really strong growth. The economy is doing well, far better than maybe it would have been expected to be doing. Second, we look at technicals, and I have several charts here. I'm going to really only focus on one. The first one here is the advanced decline line is on the bottom half. The S&P 500 is on the top half. And real quickly, we'll just show that the advanced decline line may be beginning to kind of turn over. And so that's potentially a negative for stocks. Another set of data that tells a similar story is when we look at the moving average. So you want the stock market to be above its moving average, and it is. It's well above its 200-day moving average. But then you also think about the number of stocks that are above their 200-day moving average. And for the market to really be strong, you need all the individual stocks to also be above their moving average. And if you see here in the fourth quarter, really in December, the momentum kind of petered out. So the stock market is not quite as broad in terms of the number or the percentage of stocks that are still in a strong uptrend. So again, this bodes for a potential pullback. Now, this data goes through the end of December, and if we ran the chart today, it would show 61% rather than 56. So it's ticked up a little bit, and I think that could be some kind of Trump optimism or just growth optimism. Another way to look at this is the number of stocks making 52-week highs, which there are almost none now, but also there are very few 52-week lows. So it kind of bodes well for maybe kind of just a trendless market that might be a little bit range bound. So not really a positive or negative on the technical side. Investor sentiment is also neutral. There are some positive things happening in investor sentiment. So one of the things that we think of as a contrarian reading is investor sentiment, individual investor sentiment. And you can see here, the green line has been pretty high for quite some time, and that's not been a positive for us. Well, the green line, which is bullishness, has come down closer to its long-term average. And the bearishness, the number of investors that are pessimistic, has actually come up, which is good for us. So this is actually moving a little bit more towards normal. And there's some other things we think of. Consumer sentiment. This is also a really important data set to look at. And I'm going to kind of use the laser pointer here again. If you look here, the pre-COVID period, you had sentiment pretty high, then it dropped through the floor all the way through 2022. And we've seen a really good rebound from the low of 2022. And in fact, the last 5 months, it has recovered, but we're still not anywhere near these levels of pre-COVID. So it's making progress, but we're not right in a place yet where we would call ourselves optimism. One group of people that has become really optimistic since the election, in fact, is the National Federation of Independent Businesses. This is the small business index. And so optimism has just shot up based upon, the perception is based upon Trump's win, because he's going to be a little more business friendly. So now I want to shift from sentiment and go over to valuation, and I will pass it back to Pete to talk about some stock valuation measures.
So here we want to talk about really the spread between growth and value. And again, I want to go back to this theme of turning things on their head a little bit, which is the whole idea of inversion. You want to turn something upside down to get a real sense of it. If you think back a couple of years and you look at the end of 2022 and look at that growth price level, you were looking at Russell growth at a PE of 25, and it had gone down materially after 2021. So part of the reason the performance for growth has been so good the last couple of years is PE's expanded from 25 to 38. That's very impressive and likely to be unsustainable. And the risk is that that could go down materially, right? On the other hand, the value price to earnings multiple is much lower. And you would say, well, historically, relative to its own history, it's not cheap either. But the other point to make is that value earnings have not expanded quite the way growth earnings have. And in a stronger economy, value earnings could do much better going forward. So this spread looks very large relative to history and supports diversification away from growth, not sticking with growth, right? And that's an important factor for us to think about. And again, supports the theme of broadening that we've been talking about, which of course is the benefit of diversification, right? Last year was concentrated markets. Well, what's the other side of the coin? Diversification. So that's one key thing to take from this slide. The other thing I would mention is this is true when you compare small and large caps. It's also true when you compare geography, so US versus the rest of the world. And all of that's been driven by the US exposure to the growth area, right? The US market's been pulled up relative to everything else, and large caps have been pulled up relative to everything else because of these growth stocks and these growth valuations. So that's a key point to make here. And then the next slide. So this is another valuation measure. This is free cash flow yield. And the interesting thing here, if you highlight the yellow line in your eyes and you look at 4.6%, you'd say, well, that's not that great a free cash flow yield. Well, actually, on a free cash flow basis, it's actually pretty high relative to the history on Russell Midcap. And the other point I'd make on that is the only other times on this 25 to 30-year history we've got that the Russell Midcap free cash flow yield was higher than it is today, we were effectively in recession. 0203 was the recession after the tech bubble. 0910, that was after the financial crisis. And then in 2021, well, that was the pandemic-driven recession. So either mid caps are telling us that we should be in recession, and maybe we're going to be, right? We don't really know. We don't think that there's likely to be a recession in the next 6 to 12 months, given the current growth outlook, but it's already priced for recession. Meanwhile, the growth free cash flow yield is basically at the most expensive end of its levels and was only more expensive just prior to going into a recession. So the spread here, while it might not look that gigantic to you, if you look in the box in the upper right, remember the theme of inversion we talked about. An inverted yield is actually the price multiple. So price to free cash flow for Russell Growth is almost double what it is for Russell Midcap. To us, that's telling us that looking forward, we have a much better opportunity from a risk-adjusted return framework in small and mid caps than we do in large. And I'll hand it back to Nathan to tell you why that's important in fixed income as well.
Yeah, and the only comment I'll make as I kind of shift over is, as you were talking here, it just strikes me that valuation is not something you use to make short-term decisions, right? And so this slide, kind of affirms that. And also, as we look at the relationship from a valuation standpoint for bonds relative to stocks, this is a very, very long-term measure. Okay, so what this is showing us is the Bloomberg aggregate bond yield, right? So the overall investment grade bond market in gray. And then we've got the S&P 500 earnings yield. So it's trailing earnings, and this is the inverse of the PE. So right at 3.8 gives us a 26 trailing PE roughly. And what you see then is at the bottom, you've got bond yield minus the stock earnings yield. And so if you look back during the 90s and even the beginning of the 2000s, bond yields were higher than stock earnings yield. And that makes a lot of sense because stock earnings yield grows, but bond earnings yield are not going to grow. So you demand, higher yield in cash from your bonds than you do in earnings yield from your stocks, because your stocks are going to earn more 5 years from now and 10 years from now. Well, that relationship kind of turned on its head after the tech bubble burst because interest rates dropped. They started to go back up, but then during the global financial crisis, they dropped again. And then you had this 15-year period where bond yields were so low that that's where the acronym TINA, there is no alternative, came from, is because bond yields were so low, it just wasn't as sensible to invest in them. Well, that has changed, and you can see now that bond yields are actually really, really attractive relative to stock yields. That doesn't mean you should buy bonds today and sell stocks today, but it just means that bonds are actually something you might want to think about again, and you didn't really have to do that for 15 or 20 years. So again, a framework is really, really important. And so I will put this chart up that kind of highlights what we just went through, although I won't spend a lot of time talking through it. But just to note, we are kind of relatively neutral here, right? We've got two technicals and sentiment that are neutral. The economy is positive and maybe getting more positive, and valuations are negative. And we say that because large cap stocks and investment grade bonds, corporate bonds, yield spreads are low and valuations are high, but there's a lot of opportunity inside bond land. But one of the things that is really important, you might recall that yesterday we had a new president inaugurated. And so looking forward, there's a lot of policy uncertainty, and this chart illustrates that, and it illustrates where it comes from. So the gold line is the U.S. Economic Policy Uncertainty Index, and it's really interesting to see the trend of this. After the tech bubble burst, you had decline. After the global financial bubble, or after the global financial crisis, you had uncertainty decline over time. Then again, after COVID, you had uncertainty decline over time, and then that popped up a little bit here. And it's important to see why. The trade policy factor is what has really driven this. So we need to acknowledge the fact that there is a lot more trade uncertainty. So let's talk about policy effects and what Trump might want to do, what he might actually do, and how that might affect your investments in 2025. So first on tariffs, Trump, again, a comment on Trump is we all know that he speaks with a certain bluster, and not everything he says is something that actually gets done. And so he is talking about a lot of trade tariffs, and we'll see if they happen. But the one key thing that relates to fixed income about this is points number 2 and number 3 here, which is they are likely to increase inflation structurally, which is likely to cause rates to maintain higher or go higher. In other words, there's kind of going to be an upward bias towards interest rates. Tax cuts, the bullet point here kind of makes the case. It would have been more important to talk about if they were going to not get extended, but we believe they'll get extended, and so it's less of a big deal. Deregulation is going to be positive for energy production, positive for banking, and the overall financial markets and possibly M&A. And then this last one, the government efficiency, we think there's certainly some risks here. We wrote about the government debt and it being unsustainable, and there's a really big need for this. It remains to be seen what exactly this government efficiency panel can accomplish. But it will be interesting for sure. So let me pass it back to Pete to talk about what we want to think about next in terms of 2025.
These next couple of slides here highlight the concentration issue in the market. We don't want to spend a lot of time on this because this is really kind of rear view window, but the reality is what has happened because of concentration. The second bullet point here, many investors have now migrated to what we would consider to be unbalanced portfolios. They've allowed their portfolios to grow in one area and not rebalanced, right? And the interesting thing about this is diversification becomes a great attribute at these points in time. And you can see that after the big move in the tech bubble, the unwind took 15 years, right? And diversification was better for 15 years after it finally unwound. We don't know if concentration is going to unwind immediately or if we're going to crest here for a little while, and maybe we'll stay at 38 to 40% concentration. But the important thing to be aware of on concentration is it doesn't have to necessarily reverse and go down immediately for it to matter for diversification purposes. All it has to do is stop getting more concentrated. If we stay this concentrated for the next couple of years, diversification will still be fine. It's just whether or not it gets a lot more concentrated. So the next slide kind of gives a little bit of history on it. And I think one of the things as we scroll through this, Cole Pearson added some effects on this on an advisor call recently. And if you advance it, you'll see the Magnificent Seven in 23 and 24 had a lot to do with pulling large cap up on this slide. But let's remember what happened in 2022, right? And if you get too focused on the concentration, you just might have a real serious down year in that specific area. Now, it turns out in 2022, if you had owned commodities or commodity exposure, you would have gotten pretty good returns. But you look at this chart, historically, commodities aren't a place where a lot of people want to be, right? But that's kind of how things work. And if you recall, the oil price was exceedingly low at that point in time. And that had a lot to do with why commodities did well, that there was a recovering economy, recovering earnings in 21 and 22. And there was a valuation correction in the Mag 7. So if we continue to have a strong economy, we would expect that valuation correction. And what does that mean? And that's great to advance. And what does that mean for long-term returns? I mean, we just completed our capital markets assumptions. And if you look at this chart closely, you'll see that little blue box shows that large cap PE multiples are very high, and subsequent returns from that level tend to be pretty low, never above 5% for large cap. Now, that does not mean that other areas of the market can't do better, but it does kind of highlight this theme that diversification is kind of the opposite of concentration, right? And if you look at our return assumptions on the right, you'll see that we have much better return assumptions for small cap and mid caps, international, and we're leaning that way in our portfolios, right? We're overweight those areas as a result. And as to kind of piggyback on Nathan's comment earlier, this is a longer term mechanism. This does not reflect short-term performance or our expectations over 3 to 6 months or 1 year, but this tends to work very well on a forward 3 to 5 to 10-year look. So that's very important. And moving on to the last couple of slides before we want to talk about the investment drivers for next year. We expect employment should hold reasonably steady. The inflation outlook, Nathan's already kind of covered that. It could stall for the first 6 months. We hope by the back half of the year it starts to look better. The risk, of course, is interest rates have to stay higher for longer. And then currency, the current run of dollar strength we would expect should begin to fade, and that should help. And the earnings backdrop should continue to be good with everything we're talking about, very much aligned with that. And valuation should actually start to reflect that. And so you should start to see a little bit better valuations for small and mid in this environment. And there's no reason for growth valuations to stay so high when the rest of the market is performing better. So we would expect those spreads to come in. So that's very important for the outlook. And I think I'm handing it back to Nathan. Oh, excuse me, I'm not. I jumped ahead of myself. I have 2 comments to make about the portfolio and how we're constructing it. New power demand is expected to be exceedingly strong over the next several years. You can look the last decade from 2010 to 2020, power demand was basically stagnant. But this next decade, particularly the second half, power demand's going up quite a bit. Well, this is a great story, but it's supported by the Mag 7, right? The Mag 7 needs power. Power availability has to come through. So one area that we're emphasizing in portfolios is a new position that's targeting energy infrastructure. And Nathan mentioned M&A a little bit ago. Well, Constellation recently made an announcement to buy Calpine, which is a natural gas producer. And last year, Constellation made a deal with Microsoft to restart 3 Mile Island. So Constellation is positioned, whether or not it's nuclear or natural gas, Constellation's positioned to benefit tremendously going forward. And that's a big position in this portfolio. And another strategy that we're employing going forward is the focus on free cash flow. I mentioned that in an earlier slide. Free cash flow yield tends to do very well over the long run from a risk-adjusted return point of view, as you can see, relative to all these other metrics, valuation metrics. Price to free cash flow yield tends to have better returns over the long run at a lower risk. So we are focused on putting together a portfolio with a high free cash flow yield. And right now, this strategy we've added to portfolios is coming in with a multiple discount to the market of 50%. So I think I'm handing it back to Nathan at this point. Sorry, I jumped the gun on my earlier comment.
No worries. I think the only comment I would make is who had restart 3 Mile Island on their bingo card for 2024 outlook. I don't know that anybody did, but it's really impactful and illustrative of the magnitude. So let's talk about asset class positioning. So this might look a little bit negative. You can see we're kind of positive on bonds and there's some risks there, but I think what might strike you is that we are not really tremendously positive on any particular stock sector. And the reason for that is this is a little bit of a short-term outlook. And so, we've had a pretty solid run of large cap stocks and valuations are high. We actually just downgraded small and mid cap US stocks from positive to neutral because there have been a couple of kind of negative earnings revisions throughout December. And again, this is kind of a short term. On a long term basis, we're still really positive. And then, internationally emerging markets were neutral. And I think that just reflects kind of a Trump presidency. So how does this relate to your portfolio as we wrap up here? So this shows our peak allocation, which has our tactical views inside of it. And these are our 5 different allocations, and we generally focus on the middle here. And so this is a balanced portfolio. This is a 60-40 portfolio, and you'll note that it is not 60-40 right now. It's just a touch away from that. That's because in our tactical sleeve, back in December, we wanted to keep a risk on posture, but we were a little worried about equity valuations. And so we bought a high yield bond, a private credit company in our fixed income portfolio. And so we are slightly overweight fixed income, but with a manager that allocates to private credit. So we're still kind of risk on in that sense. Another thing to kind of think about is that our international emerging market allocation has dropped a little bit. Our large cap has increased. And in fact, we've actually gone another step. So there's a couple % more in large cap US stocks. It's really kind of a reflection of Trump and positive momentum continuing in the US market, and a little bit of negative momentum in the international markets. So if you have any further questions, we would love to talk to you about it. Please reach out to your advisor, and let me turn it back to Cole and see if there are any questions for us.
Great. Thanks, guys. Thank you to both of you for sharing so much good information. Again, if you've got questions, info@oneascent.com, you can email, or you can use the Q&A feature here in Zoom. We do have a couple that have already come in. Nathan, I might ask you to go back to the asset class return chart. The question was, large caps seem to be at the top consistently over I think it was 10 years we were showing. Go back to the periodic chart. So Pete, I'll direct this question to you. You were talking about the slide. Why would you allocate to anything other than large cap if it's consistently at the top? Can we talk a little bit more about diversification and the value there?
Excellent. Thank you. Great question here. Really, it's really striking when you look at this slide. If you look at asset allocation, it always is in the middle. But look at last year. Asset allocation was actually in the top 3 slots. I don't believe this slide. I used to work at JP Morgan, and I think this slide's been in existence since 2001 or 2002. And the point here that's very interesting. Okay, so large caps, you look at this, they're mostly in the top half, except for 1 year in this history. But if you looked at this slide 5, 6, 7 years ago, you'd remember that in the first half or the first decade of this millennia, large caps spent several years in the bottom half. And it's hard for people to remember that that can actually happen. And I would highlight to you that in 2017, 2018, when I used to market this slide, REITs were the best performing asset class over the trailing 15-year period. And people would ask me, why wouldn't I just have a big overweight to REITs? Look how great they perform. And you can look at it from 2010 to 2015, they were in the top 5 out of 6 years, right? Well, I used to tell people REITs are pretty much overvalued. And if interest rates go the wrong direction, and we thought interest rates were historically low, REITs were going to have a couple of years at the bottom of the list. Well, look what happened in 2020 and 22, right? Didn't happen the next year, but within the time frame we were talking about, REITs had 2 tremendously terrible years. So it's not unlikely that large cap is going to have that kind of experience. And indeed, in 2022, wasn't that long ago, the Mag 7, as Cole pointed out on this chart with his 46.7% decline, that pulled large caps down 20%. And we're set up for that potentially again. So that's important for people to keep in mind. And I think when you look at these slides, this is a great slide to share with clients because it's a good reminder to talk about diversification. You think about the last 10 years, large caps have beaten small caps 8 out of 10 years in the last 10. But on the first 5 years of this slide, small caps beat large 3 out of 5. So I think little things like that you can point out to your clients to remind them that the world doesn't always just kind of stick to the game plan that it's recently been running on. It often changes. And when it changes, it turns upside down. So I just want to remind you of that. And just a couple of years ago, commodities had been at the bottom for 8 years, 9 years, and then they had 2 years where they were in the top 3. So the one thing about this slide that's clear, none of these are stable. They move all over the place. So keep that in mind. And we don't expect large caps to stay at the top for the next 5 or 10 years. We expect them to migrate lower over time, and that other asset classes will perform much better.
That's great. Thanks, Pete. Another question, Nate, for you. You started talking about interest rates. Can you give a little bit more color on kind of what's the outlook for us? What are the risks associated with rates to our outlook?
Yeah, I think the risk to interest rates is really related to inflation. So one of the huge components of inflation is currently rents, so owner's equivalent rent. And I pulled my Bloomberg up to try to see if I could pull a chart up to discuss this, but I'm not sure I'm going to be able to. If you look at current mortgage rates, they're over 7%. And that's because people have been getting their mortgages during this period, right? And mortgage rates haven't quite come down as much as interest rates have come down as inflation came down. Well, when we had a low inflation period back here for 20 years, a tremendous number of people got really low interest rates on their mortgages. So, mine 3 years ago is 4.25. Some people had below 3. But the rate today is about 7%. And so what's happening is the average mortgage rate is something like 3.5%. And the current mortgage rate is about 7%. And so even if rates drop 1% or 2%, the average is going to continue to go up. And that is actually a key piece of inflation. And so there is upward pressure on this component of inflation. Another thing that we have talked about some in the past is some big deflationary forces. One of those is globalization, which is kind of being undone a little bit. One of them is demographics, which is not as big of a factor right now. Another one is just technology, and technology is doing fantastic. But there's maybe a little bit less of a disinflationary push there. So some of the things that have kept inflation down may be less impactful going forward, and we've got some pressures that may keep it higher. So put those two together, and there's a decent chance that inflation may be higher than we expect.
Great. Thanks, Nate. We want to be mindful of time, so maybe time for one more. And Nate, I'll direct this question to you. I know you've studied this topic for us. Cryptocurrency with President Trump, newly inaugurated yesterday. His views on cryptocurrency. What should investors be thinking about as it relates to crypto?
Yeah, well, so I mean, first of all, to acknowledge that my answer will probably offend everybody, and there's not a great answer to crypto because you think of crypto as a new technology, and it's it follows a trajectory more like Amazon or Apple or Microsoft, and you can look at it through that lens. But if you think about it as an asset, there is a very difficult problem of how to value it. So what is an entry point for Bitcoin? What do I, do I buy it at 74,000 or do I buy it at 38,000? What's it worth? And the problem is because what's it worth really relates to kind of everything else. It is kind of an anti-asset. It's an asset that kind of is designed to protect you against everything else in the financial system not working well. So that's where I have struggled a little bit, is kind of to place a valuation on it. And so the way we're going to need to interact with crypto is a little bit more of a technical perspective. And so I've been working on it for a year or two, and it will likely at some point in some way, shape, or form find its way into our alternatives portfolio. That's probably the most logical place for it to be. So that may be an unsatisfying answer for those who love it and an unsatisfying answer for those who hate it. So I've offended everybody. So thank you, Cole, for that question.
Well, great. Well, that is all the time we have for today. If you have questions or want to follow up with us, you can find more on our website, investments.oneascent.com. We'd love to hear from you. Email us. Lots more resources available to you. Again, we want to partner with you in values alignment through our solutions, through our tools, and through insights. So thank you all for being with us this morning. We greatly value and appreciate your time. Nate and Pete, want to thank you all as well for sharing your wisdom. That'll conclude our call today, and you may now sign off. Have a great rest of your day.